Hello, everyone. Welcome to our second lecture in the Foundations of Investments course. Today, we're going to explore some different types of financial instruments, their roles, and how they fit into the larger picture of financial markets. By the end of this lecture, you'll understand concepts such as primary versus secondary markets, equity and debt securities, as well as money market instruments and derivatives. So let's jump right in. What is a financial instrument? Essentially, it is a contract that generates a financial asset. Right? So financial securities are financial instruments created to be publicly traded. They generally fall into one of the following categories: equities, debt, money markets, derivatives, and foreign exchange. So when we hear the term financial securities, it refers to financial instrument created for the purpose of public trading. Think of Apple and its shares listed on NASDAQ. Their shares are a form of equity securities that represents ownership in the company that can be bought and sold by the public. In contrast, an example of a financial instrument that's not publicly traded security would be a loan agreement between two private parties. The primary market is where a company first issues securities to raise capital. Imagine Apple decides to raise funds to build new facilities, so it issues new shares through an IPO, initial public offering. This transaction occurs in the primary market. After the IPO, when investors like you and I buy and sell these shares on the stock exchange, that happens in what's referred to as the secondary market. Let's take Tesla, for instance. When Tesla went public in 2010, they sold shares for the first time in the primary market. Now, when we trade Tesla stock on platforms like Robinhood or E-Trade, what's happening is this is secondary market transactions. Direct investments occur when investors provide capital directly to the company, usually through what we refer to as private placements. They really aren't available to the public. Think of a private equity firm like Blackstone or venture capital investors you might see on shows like Shark Tank. These firms provide capital to startups in exchange for ownership stakes. They're less regulated by the SEC, meaning that investors must do their own due diligence to ensure that they understand the risks that are involved with these types of investments. Venture capitalists invest in small, often unknown companies, hoping that they will eventually grow. Consider Amazon in its early days. Jeff Bezos pitched his startup to venture capitalists to raise initial funding. These early investments allowed Amazon to grow into the giant company it is today. And again, Shark Tank is an example of how venture capitalists actually work. So regulation is important for many reasons, but primarily we want people to act fairly without undue advantage. When securities are publicly traded, the Securities Exchange Commission oversees the regulations to ensure transparency and fairness. Public companies like Google are required to disclose important information, like quarterly earnings reports, so that investors can make informed decisions. The SEC helps maintain trust in the system by setting these rules. Public firms use underwriters to assist with issuing new securities. For example, Goldman Sachs often serves as an underwriter for major IPOs like that of Facebook. Now it's Meta, back in 2012. Underwriters research the company's financials, determine a fair price for the securities, ensuring that they are attractive to investors while maximizing the funds raised for the companies. So what do these underwriters do? They gauge the level of interest by investors. They help set prices for the shares. For instance, if a company is issuing shares in an IPO, the underwriter's job is to make sure enough investors want to buy those shares at a good price. This is crucial because underpricing can leave money on the table, whereas overpricing can result in unsold shares. There are two ways that underwriters or investment bankers get paid. In a best efforts agreement, the underwriter does their best to sell the shares but makes no guarantees. In a firm commitment, the underwriter buys all the securities from the company and then sells them to investors. The risk in a firm commitment is on the underwriter, while in the best efforts agreement, it's on the issuing company. Think of Uber's IPO. Investors were on the hook to sell shares at the price they set, absorbing the risk if investor demand was lower than expected. A prospectus is a document that gives investors a picture of the securities. It's created to provide information about the security, some of the risks of the investing company. What are some of those known risks? Well, these statements are going to present some obvious and some not so obvious risks of this company and the securities being offered. And it is an initial document that's issued. It's considered a draft, if you will, and then eventually a prospectus, a full prospectus, is later offered. So again, initial public offerings, just to bring us back to the square one again. This is the first time a company issues securities to the market. Sometimes managers and employers will offer the stock first, often at a lower price, since there's no market yet. Insiders can be prevented from selling this stock, though, for a set period of time. Sometimes we refer that to as a lockup time. So that's the end of this part of the video. I look forward to seeing you in the next video.